Welcome to this explainer. Today, we're going to break down the complex mechanics of something called IRMAA, and I'll show you exactly how to navigate this incredibly frustrating Medicare surprise. Seriously, if you're approaching retirement or you're already there, this is information you absolutely cannot afford to miss. Let's get right into it. So, are you ready for the most frustrating surprise in Medicare? We're going to dive right in and address a massive hidden danger that hits so many new retirees right in the wallet, literally the moment they leave the workforce. You know, you've planned your savings, you've been looking forward to your golden years, and then, boom, out of nowhere, you get hit with a bill you just never saw coming. Now, navigating Medicare can definitely feel like swimming in alphabet soup, right? But IRMA, which stands for the Income-Related Monthly Adjustment Amount, well, it's really just Medicare's way of asking higher earners to pay a larger share. Here's the kicker. It's not your base premium. It's a completely separate surcharge slapped right on top of what you were already expecting to pay. Here's our roadmap for this explainer. First, we'll cover the hidden surcharge itself, then the dreaded 2-year look-back rule, why you need to beware the IRMAA Cliff, how to appeal using life-changing events, proactive Roth Conversion Strategies, and finally, how I can personally help you out. All right, Section 1, the hidden Medicare surcharge, paying a larger share. So if your income crosses certain lines, Medicare automatically tacks on an extra cost to your standard monthly premiums. And this applies to both your Part B, which covers your general medical insurance and doctor visits, and your Part D, which is your prescription drug coverage. These surcharges, they get added directly on top of whatever standard monthly premium you're already paying for your specific plans. And honestly, it can be a massive shock to your monthly budget if you aren't prepared for it. Moving right along to Section 2, the 2-year look-back rule, the timeline trap. Okay, pay close attention to this because it's a real trap. A one-time financial windfall in 2024 will directly dictate the unexpected IRMAA bill you receive in 2026. The Social Security Administration determines your IRMAA based on your Modified Adjusted Gross Income, or MAGI, from 2 full years ago. Why exactly? Well, because your tax return from 2 years prior is simply the most recent, complete data the IRS has on file when the new Medicare year begins. So, say you sold a house or you did a massive Roth conversion in 2024, that income spike will suddenly trigger a huge premium hike 2 whole years later. It's wild, right? This brings us to Section 3. Beware the IRMAA Cliff, a high-stakes game. Let's look at the 2026 landscape based on that 2024 income we just talked about. The standard Part B premium for 2026 is roughly $202.90. If you're married and filing jointly, as long as your MAGI is $218,000 or less, you just pay that base amount with a $0 Part D surcharge. Nice and easy. But take a look at Tier 1. The literal moment you cross that $218,000 line, your Part B premium jumps to $284.10, and a $14.50 Part D surcharge gets added right on. The crucial thing you need to understand here is that this system operates on a cliff. This isn't a gradual slope. Crossing the threshold by a single dollar throws you right off the cliff and triggers massive surcharges for 12 full months. If your joint income is $218,001, you don't just pay a tiny tax on that one extra dollar. Nope, you pay the higher premium for the entire year. And keep in mind, RMI is recalculated every single year. So sure, if your income drops the next year, your premiums will eventually drop back down, but you are absolutely still on the hook for that whole year you fell off the cliff. Which leads us to Section 4, appealing life-changing events, the retroactive fix. Now, there's a bit of good news. The Social Security Administration does have an appeal process using what's called an SSA 44 form, but they are incredibly strict about what actually works. They draw a hard line between events completely outside your control versus voluntary financial choices. For example, if you experienced a work stoppage, which is just a fancy government way of saying you retired, your income obviously drops significantly from your working years. That perfectly qualifies for an appeal. Other things, like a reduction in hours, a marriage, divorce, or the sudden death of a spouse, those all qualify too. However, if you voluntarily sold a rental property, or cashed out stock, or executed a large Roth conversion, they will flat out reject your appeal. You actively chose to realize that income, so you've got to pay the surcharge. Let's look at how to properly handle those voluntary actions in Section 5, the Roth Conversion Strategy, proactive protection. This brings us to a super proactive IMAA-aware strategy known as bracket filling. Essentially, this slowly drains your pre-tax accounts without triggering that nasty Medicare penalty. Look, converting a traditional IRA to a Roth IRA is generally a very smart move because it reduces your future required minimum distributions, which down the line could easily push you into permanent IRMAA tiers. But doing it all at once, that triggers the cliff today. So instead, the strategy is to find your specific target ceiling, convert funds exactly to the edge of that limit, and do this in careful stages over 5 to 10 years. Let's run the actual math on this. By calculating your exact buffer to the penny, you can secure tax-free growth for your future while totally maintaining that standard Part B premium. For example, if a couple has a projected 2024 MAGI of $180,000 and their base tier ceiling is $218,000, well, their buffer is exactly $38,000. They can convert exactly $38,000 to a Roth IRA. Sure, they'll pay standard income tax on it right now, but in 2026, their Medicare premiums will not go up a single cent. But, and this is a massive but, if you get sloppy and convert just $5 over that limit, let's say you accidentally convert $38,005, you instantly trigger Tier 1 for both spouses. Because of the cliff we talked about, that tiny $5 mistake ends up costing your household over $2,200 in unexpected Medicare surcharges for the year. Just think about that for a second. $5 in extra income directly translates to over $2,000 in lost wealth. It is mathematically brutal, folks. And that brings us to Section 6. Let me help you. Expert guidance awaits. My name is Eric Burns, and I am a licensed insurance agent serving states all across the Southeast and beyond. I am fully equipped to help you navigate this extremely complex maze. I understand exactly how these cliffs work, and more importantly, how to structure your specific plans so that you aren't leaving your hard-earned money on the table for the government to sweep up in these crazy unexpected surcharges. Seriously, please don't try to DIY a strategy that has so many hidden cliffs. Reach out so we can safeguard your savings together. You can email me directly at eric@ericburnsinsurance.com or just give me a call at 678-404-9230. I'm licensed in Alabama, Florida, Georgia, Mississippi, North Carolina, Ohio, South Carolina, Tennessee, Texas, and Virginia. And as a required TPMO disclaimer I need to share, I do not offer every plan available in your area. Any information I provide is limited to those plans I do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. So here is the ultimate question for you to consider today. Are you ready to proactively protect your retirement income? Or are you going to let IRMAA dictate your future? I highly encourage you to take that critical first step and reach out to me today so we can secure your peace of mind. Retirement is supposed to be your time to finally relax, not a time to pull your hair out stressing over 2-year look-back rules and $5 mathematical mistakes. Thank you so much for joining me for this explainer. Take control of your planning, and I really look forward to speaking with you soon.